It is, as we mentioned, a big week for data, and the biggest number of all comes Friday. That's when the Labor Department releases the August jobs report. It is arguably the one number Janet Yellen and her fellow Fed policymakers will study closest as they decide when to raise interest rates and by how much. Steve Leisman dives into the week's data highlights.
It's a big week in the United States for jobs data, and that means a big week for Wall Street to figure out whether the Federal Reserve could be hiking interest rates sooner than it expects. The first piece of data is the ADP private payroll company, which is expected to forecast that 215,000 private sector payroll jobs were created in August. Jobless claims seen at a relatively low 300,000, and then Friday, the big non-farm payroll number seen at 220,000, or the seventh month in a row above 200,000. The unemployment rate is forecast to decline by 0.1% to 6.1%, and average hourly wages up 0.2% from unchanged a month earlier. In Fed Chair Janet Yellen's own words, if the improvement in the job market is more rapid than the Fed anticipates, it could move up the timetable for rate hikes.
We're kind of in the view of the summertime. But the most questions we're getting is, could it be earlier? Could it be, particularly I think a lot of people have their eye now on the March meeting of next year as a possibility, again, conditional on the jobs numbers looking, good over the remainder of the year.
Some key areas to watch in addition to jobs, which are up by 245,000 over the past 3 months. The labor force has been up by 200,000 as more people have been attracted back into the stronger labor market. People working part-time for economic reasons up a small 22,000 over the past 3 months. And real wages, well, after adjusting for inflation, they're up just 0.02%. That's a number Yellen thinks can be much higher without causing any inflation. So what would it take for earlier rate hikes?
I think we have to see, perhaps unemployment down more than just a tick, 2 ticks or so. And I think we also have to see some evidence of wages really starting to pick up.
Now, a rate hike 3 months earlier than planned is not a particularly big deal. What would matter is if the Fed gets more aggressive during the year so it ends 2015 at a higher rate than Wall Street now anticipates. By Friday, the market should know if the data from August shows the job market healing more quickly than expected. That would prompt the Fed to take a tougher stand on rates. For Nightly Business Report, I'm Steve Leisman.
Jonathan Golub is calling for the S&P 500 index to hit 2075 by the end of this year. He's chief U.S. market strategist at RBC Capital Markets. Jonathan, by my quick calculation, if you're right about that forecast, that means the S&P will be up more than 12% this year. And yet you heard our packages, a lot of risks, a lot of worries, a lot of fears. What are you seeing that makes you so upbeat?
Well, I mean, if you look at this year's performance, returns in the market, it's all driven by earnings. This is not speculation. It's not a market that's higher because simply someone's willing to pay more than the guy before. This is a market that's giving you in returns what companies are delivering earnings, and that's a very healthy thing right now. And interest rates where they are means that you really do have the potential for stocks to go much higher.
Daddy, tell me why bull markets end, and do you see anything out there that would end this one?
Well, bull markets, and it's a great question, bull markets end really when you get towards your next recession. They don't get tired, and frankly, they don't even really get expensive. Geopolitics doesn't matter as much as we like to think. And the key is that the risks of recession right now seem quite remote. What you'd really need to see is a real meaningful pickup in inflationary pressures that forces the Fed, almost scares the Fed into acting more aggressively than they want to, and we're nowhere near that right now.
All right, so Jonathan, are you saying that you're just going the way you've been going all summer long, all year long, the same investment strategy, or here it is, September, back to business? Are you making any changes in your portfolio or your investment approach?
For the most part, the answer is no. I mean, you need to have a reason to want to change. And what we're seeing is an economy which is growing at a nice clip, but not, too fast. Corporate profits, which are surprising to the upside, and valuations which seem quite reasonable. So no, we like the same sectors that we've liked before, and we think investors are really going to be well served to stay in the market, not just for September, but probably for the next couple of years or longer.
What sectors are those that you like best?
There's three that stand out. The first one is financials. If we get, as we and most expect, a rise in interest rates from here, and I'm not talking about something huge, but even just incrementally, financials are the big winner on that. If the economy progresses forward as we and the market expects, then industrials are the big winner on that. And the other standout is healthcare, which has been doing really well, and we think, given their growth prospects, should do well, especially biotech stocks. I know that Janet Yellen hasn't been a fan of the group, but I think it's an area where you can really find growth at a high valuation, but a reasonable valuation given the growth prospects.
All right, so you have a very bullish forecast. You're not worried about geopolitics. You're not worried about the Fed. But what is the wild card? What could upset your upbeat scenario?
Right. I mean, probably the single thing that would make me more concerned is if we did see inflationary pressures start to spike up. And, we know that the Fed is printing money. We know that they're trying to slow that process down right now and eventually raise rates. But if the Fed saw that inflationary pressures were really picking up, they would be forced to leapfrog this process, jump further ahead, and that would be very upsetting to market. Now, we're not there now, but it's the single thing that I'm really keeping an eye on.
All right, Jonathan, thank you so much. Jonathan Golub with RBC Capital Markets.